That's going to be a complete shithole.
Hello again, it's been a little while. In today's video we're going to be talking about the area. What types of areas of the UK do you want to be investing in? What are the key things to look out for? And how does this change depending on what strategy you're doing? Right, so like I said, it's been a very long time since I've actually gone through the Fontaine Brothers course in terms of their videos, their video training, and kind of done a review. The last time we did it was videos 20 to 30, it was on compliance. This is 30 to 40, it's on area and strategy. And I know I've talked a little bit about area and strategy in a previous video. You can probably find it here or in the description or something like that. Now, you know, I've had a few months to sort of digest it and can do a proper review. So what they suggest, that they do not mince their words.
There's going to be areas that are complete shitholes, and there's going to be really affluent areas.
Don't go for a shithole or a really affluent area. Go somewhere in the middle. So yeah, of course, makes sense if the quality of the area is so low that, you know, people are unreliable, they're on drugs, they are jobless, then you don't want to be going for those areas. And one that actually was a little bit more of a surprise to me. Initially you think, well, I want to invest in property, I want to get rich through property, so if you can't beat them, become them, or whatever the saying is, and maybe investing in a posher area is the best idea. But at the end of the day, there's not much more wealth to be made in a desirable postcode. Yeah, unless something's really run down, in a desirable postcode that's already pushed up the price too much to where you can make much profit from it. And the way to sort of check these things is with Street Checker. I believe that's a website. I'll link it in the description. Really helpful, really useful. You can look at all sort of demographic details, and Dylan gets into that in one of the training videos, so that's really good. So strategy, how does that change the sort of areas that you're looking in? Don't you always just want to be kind of somewhere in the middle, not too, you know, Goldilocks zone, not too shit, not too affluent? Well, actually, for rentals, you want to be slightly more towards the shitter end, but still, you know, these tenants are going to be long-term reliable. They're not on drugs, they've got a stable job, but you know, they're sort of working class, and you know, these people, they're not too interested in owning their own home, they're happy to be renting. Yeah, a lot of the more middle class, slightly more affluent people, you know, really do hold home ownership to of great importance in their life. So if you're renting there, you might get high turnover of, you know, young professionals, but then they're moving on. So that's one reason why, if you're renting a property, it wants to be on the sort of slightly shitter end of the spectrum. Another reason, when you're looking to buy to let or buy refurbish, refinance, or in our case, with the strategies I'm starting to look at, purchase lease option, yeah, lease it off the landlord or owner and then rent it out. You're looking for tenants, you want to be on the slightly lower end of the spectrum. Well, that's going to make the house prices lower and then your yield greater. Your gross yield is gross annual income divided by the property's value times 100, of course. So properties with a lower price. Okay, £100,000 house, rent out for £500 a month, and over a year, was that £6,000? 6%? However, a £1 million house won't necessarily rent out for £5,000 a month. It might well rent out for £2,500 a month, and therefore that's a 3% yield. So that's why you can do better renting property out if you're slightly towards the whole end of the spectrum, as they say. Cool, well, what about flips? What about when your end user is not renting, your end user is buying? So as you might expect, this pushes it up towards the slightly more desirable, slightly more affluent side. Again, not too affluent. And flipping properties, and I'm seeing this a lot actually recently in London, is there are a few properties coming back on the market that have been bought, flipped, and then they're being reduced because they're really super nice, high-end, £2.5, £4.5 million homes, amazing, but at the end of the day, how big is your target market for those properties? Very small. Not many people can afford that, and not many people will be wanting to buy a house for 4 million quid and spend whatever it would be. Let me check. Moving home, 400 grand on stamp duty on a £4 million house. I mean, yeah, you want to be slightly more affluent, yeah, but not too much so. So, you know, your middle class family that's looking to maybe buy their first home, or working professional, something like that. They want to own, they want to settle down, and they're looking for something ready to move into. So you just bought the property below market value, done a refurbishment, increase the value through that refurbishment, brand spanking new condition. If you go towards the too low end of the market, what tends to happen is there's a ceiling value on that street, and there'll be certain areas which are a little bit rougher, and you say, oh great, yeah, bought the property below market value, 350, that's a great deal in London. The ceiling value of the street is 300. If you spent 500, yeah, if you spent 100 grand on the refurb, then that's too much. You're not going to make money there. Whereas in a much nicer area, that 350 house, the ceiling value might be 600 or 650, and then you've got more margin because it's a slightly more desirable area. So you don't want to bump your head on ceiling values in those sort of areas. Those sort of areas, you're better off buy, refurbish, refinance. You're better off renting it out. Yes, you've added value, but then wait for the capital appreciation to kind of justify that added value. Don't bang your head against ceiling values. And in terms of my strategy, yeah, we mentioned on the rental side, lease options. On the flipping side, assisted sales. This can be done really effectively in the slightly more higher purchase price areas, because you've got to bear in mind the vendor. Yeah, and the vendor is lived in their house for 20-30 years. It's a nice area, they know it. Yes, okay, they've got their olive green bathroom, they've got their dark wood kitchen or whatever. They know it needs a little bit of updating, but they still want the price that they feel is fair for the property. They have a lot of pride in that property, perhaps. So with an assisted sale where you save on the stamp duty in higher value homes, that £500,000 purchase price doesn't become a headache with 50-60 grand's worth of stamp duty. Not at all. That 500 grand purchase price becomes the vendor's share of the end value of the asset after refurbishment. The stamp duty is not paid by the investor, it's only paid by the end buyer, who is obviously happy to pay it because they're not buying it as an investment, they're buying the property once the investor has refurbished it. Let's say it's worth 700 grand. Yeah, okay, this video wasn't intended to be a massive explanation of all the strategies, but you can tell with my strategy, the assisted sales and lease options, really passionate to explain them. So, in terms of how the Fontaine Brothers explained it, they perhaps didn't go into quite as much detail as I did there about dissecting where exactly the strategy aligns on the scale, but you can kind of figure that out, and perhaps they will explain that in later training videos. Again, I'm only on about video 40. Overall spectrum, the overall concept, again, they're brilliant at that kind of beginner level into property investing. Don't buy in shitholes, don't buy in affluent areas, don't buy mansions, buy in the middle, slightly lower end, because they were talking about rentals. In my opinion, when you're looking at flips, your refurb's going to be higher, your end user is going to expect higher and pay higher. You can be slightly further towards this side. So what do I think of how they explained it? Yeah, pretty good, 7, 8 out of 10, kind of thing. I think missed a few details, but on purpose, they're not trying to overwhelm you as you get started in the course. This is only the first few videos. There's actually 180 videos now on this course, so really fantastic way they've explained it overall, and nothing so far during the course that I would say is not worth the money. I'm getting value from this course. That leads me nicely on to the end of the video. I just want to say before I finish, if you want to find out more about the course I'm doing with the Fontaine Brothers, I can pop a link in the description. You'll get 100 quid off. Ka-ching! What is an already fantastically valued course. I had a bit of feedback recently because I sent this link to someone, and I know on their landing page it says, yeah, this is £12,000 worth of value and we're selling it for 500 quid, or in case 400. Yeah, that sounds too salesy and whatever. It is, But the reason that is up there is a certain Samuel Leeds teaches a deal sourcing, deal packaging course for 12 grand. I know he does a bit more than just deal packaging in there, but essentially the same shit for 12 grand. That's why they put on their landing page it's 12 grand's worth of value according to, well, the industry leader, and we're doing it for 400 quid. That was area and strategy. Join me in the next video. I've got the series going where I'm reviewing the Fontaine Brothers course and my experience through it. There's a playlist, you can watch the rest of the videos. Some of them are like this one, reviewing the actual literal course, and then some of them are looking at my general property investing journey. The last one of those was about me quitting my job, which sounds scary, but is one of the best choices I've ever made. Yes, let's go. Woohoo, freedom. All right, see you in the next one.